In this video, I'm going to walk through example 8-10. This is from the handout that I gave in class but did not complete in class. So I'll work through it right now. As we see, we're given information for a certain inventory part for the company Monique Aaron, and we're given here the inventory that they have on hand, or the inventory available for sale, as well as the inventory that is sold. If we, one thing we should do whenever we're starting these problems is look at the total cost of the inventory that's available for sale. So if we see here, let me erase this. We are accounting for how many units were available for sale, 800 plus 500 plus 1,300. We have 1,600 units available for sale. And we want to know what is the total dollar amount of inventory that we had available for sale. Remember, cost of goods available for sale, it's not reported on any of the financial statements. It's just used as inventory control. So when I add the $300 beginning balance of $3,000 beginning balance of inventory, plus the 9,600 purchase, plus the 6,500 purchase, the most amount of inventory that could be sold was 19,100. And this amount is going to be allocated towards cost of goods sold, and the value of the goods that were not sold, the remainder is going to be sitting in ending inventory. All right, over here we have the sales information. Let's look at how many units were sold. 1,000 units were sold. And we can multiply this out to get our total sales revenue, but we're not asked to do that. So we can hold off on that information right now. All right, so the first part A says, assuming that the periodic inventory method is used. Periodic method is where the company does not capture the cost of the goods at each sale. They wait until the end of the period, in this case the end of the month, and then they look at what is left over and kind of back into what the cost of those goods sold were. This periodic method is the easier method. We're asked to compute the cost of goods sold and inventory under the LIFO method and the FIFO method. I'm going to switch windows here to, where it's a little bit easier to work. So here's the information that we need. First thing we are going to do in part A is look for, we're using the periodic method. Periodic method. We're asked to look for cost of goods sold and ending inventory. And in A part 1, we're asked to do this using the LIFO method. In the LIFO method, we assume that the cost of the units sold came from the most recent purchases. We price the ending inventory based on the units in ending inventory times the cost of the beginning inventory or earliest purchases. We can disregard the exact dates of those purchases and sales because we are using the periodic method. I'm going to start by calculating the ending inventory first. So if we have 1,600 units that were available for sale and 1,000 units are sold, we have ending inventory, regardless of the method. In units, we have ending inventory of 600 units. And number sold, we have, again, 1,000 units were sold. So we're trying to count for the value of the 600 units that are sitting in ending inventory. It's the end of the period. We're working backwards into this. The last units in were the first ones sold. So the earliest units purchased are the ones sitting in ending inventory. So if I want to calculate ending inventory, I'm going to start from the beginning balance. 300 units times $10 per unit We have one inventory layer worth 3,000. We're trying to get up to 600 units. So we are going to add from the June 11th purchase. How many units are in ending inventory from the June 11th purchase? We're not going to use the full 800 because we want to account for 600 total units. So how many units were sold from that June 11th purchase? 300 at a cost of $12 per unit. Where are the other 500 units from this purchase? We assume they were sold. So my ending inventory under the LIFO method, LIFO periodic ending inventory, 600 units at a cost of 6,600. Now let's calculate the cost of goods sold under the LIFO method, LIFO periodic method. Now we're going to take the reverse perspective. We're counting for 1,000 units that were sold, and we're assuming that the sales were out of the most recent purchases. So on June 27th, we sold, let's see, well, all we need is to worry about is the 1,000. We go to this most recent purchase, so we said from the June 20th purchase, we assume that all 500 of those were sold at a cost of $13 per unit. Total cost of $6,500. We're working up towards accounting for sales of 1,000 units. So of this 800 units that were purchased on June 11th, how many of those do we assume that were sold? Well, we're trying to get to 1,000 units sold, so we are going to account for 500 units out of that June 11th purchase. And those units each cost $12 for a total cost of $6,000 in this inventory layer. And I have my total cost of goods sold under the LIFO periodic method as 12,500. I can check my work by saying my cost of goods available for sale that we calculated earlier, that was 19,100. If I subtract from that the ending inventory of 6,600, I will get to 12,500, which is my cost of goods sold. So this looks good. All right, part B to this problem says, assuming that the perpetual, oh, no, not ready to go to part B. We're still on A. That was the LIFO method. Next, we need to go to the FIFO method. So let's go to the FIFO method, again using periodic inventory. All right, so if we want to start with our ending inventory calculation, let's get to our numbers here, our information here. Now we're taking the reverse perspective. We're thinking that first inventory in was the first inventory to be sold. So what is an ending inventory? Our most recent purchases. We're trying to count for 600 units in ending inventory, and we're going to count for them as sitting in our most recent purchases. So we have 500 units at $13 per unit in ending inventory. And we need to account for, we've accounted for 500 of the 600 in ending inventory. The remaining 100 units must be from this June 11th purchase at $12. Oops. And so where did I get the 100? Well, we are trying to count for 600 units in ending inventory. And we are going from the most recent purchase and working backwards. So the ending inventory under the FIFO periodic method is the 6,500 plus the 1,200, or 7,700. Now let's look at the cost of goods sold using the FIFO method. Periodic method is periodic method still. Cost of goods sold. Well, now we're taking the reverse perspective. If we are assuming that, just erase this right here. We are assuming that the first goods that were purchased were the ones to be sold. So let's start with this, and we're trying to count for sales of 1,000 units. Let's sell these 300 units first at a cost of $10 each. This is from the beginning inventory. So that increased our cost of goods sold by 3,000. And then let's assume we started selling the next earliest purchases. In June 11th, we had 800 units at $12. We're not accounting for sales of all these 800. We're trying to account for sales of 1,000. We accounted for 300 here. So we assume we sold 700 units from the June 11th purchase. And we said the cost there was $12 per unit. Oops, sorry about that. $8,400. Cost of goods sold, we're accounting for 1,000 units. And the cost was $11,400. We can check this again by saying our cost of goods available for sale of 19,100. From this, we can subtract either the ending inventory or the cost of goods sold, and we should come back to the other number. So if I subtract ending inventory of 7,700, I will get to my cost of goods sold of 11,400. Looks good. Now I can move on to part B. Okay, looking at this data, part B says, assuming that the perpetual method was used, what is the value of ending inventory at the LIFO, using the LIFO cost assumption? All right, so scroll down here. Okay, now we are looking at the part B, the perpetual LIFO method, and we are asked to look at the value of inventory. Under the perpetual method, each sale is matched with a purchase that immediately precedes it. We're saying that at the time of, let's say, the June 10th sale, we are going to look at the inventory that was available. We're going to say the most recent in at that time. So of these 200 units, we're going to look at this in beginning balance and account for them here. When we have our June 15th sale of 500 units, we are going to not take out the 100 from the beginning inventory, but look at the most recent purchase. Okay, so we are looking at ending inventory here. So if we want to, we can also calculate the cost of goods sold. But let's start with the calculation of our ending inventory. All right, so we're going to start with with the LIFO, we say the most recent purchases are the first ones sold, accounting for at the time of the sale. So as I just mentioned, from this June 10th sale of 200 units, we say that they all came from that most recent immediately preceding purchase, which was the beginning inventory. So from that June 1st beginning inventory, we had a 300 unit sale, 300 units in inventory, minus 200 units that were sold on June 10th. We have 100 units times this $10 per unit. Then when we got to the June 11th purchase of 800 units, we sold 500 of those. So we're going to match, of these 500 units, we're going to assume that they came from this most recent purchase. So what is left in ending inventory? We had 800 as the most recent purchase. We sold 500. So that remaining 300 units from the June 11th purchase, we assume is in the ending inventory. So we had 800 units in the purchase, minus the 500 we assume were sold from that June 11th purchase. Leaves us with 300 units from that June 11th purchase at $12 per unit. You go forward to this June 20th purchase. On June 27th, we sold 300 units. We assume those all came from that most recent purchase on June 20th. And so if we sold 300 of these 500, we had 500 units. Assume we sold 300 on June 27th. That leaves 200 units, each at a cost of $13. So the value of the ending inventory under their perpetual LIFO is going to be the sum here, this 1,000, 3,600, and 2,600, a sum ending inventory of $7,200. All right, part C asks us to calculate the, assume that the company is using the FIFO perpetual method, and asks us to calculate gross profit. So remember what gross profit is sales minus cost of goods sold. So let's start by calculating cost of goods sold using the FIFO perpetual method. So remember FIFO, the first inventory to come in, the earliest purchases, we assume those are sold first. So on our June 10th sale, every time, this is the perpetual method, so every time there's a sale, we can look at the most recent inventory and assume that was sold. So on June 10th, there was a sale, June 10th sale of 200 units. We say that that was from the most recent inventory, which is the beginning inventory of $10. And then on June 15th, when there's a sale of 500 units, well, we still had 100. We accounted for 200 of the beginning inventory when we sold on June 10th. So we start by selling the remaining 100 units in beginning inventory at $10 per unit. So we sold all of those. And then we sold units out of our June 11th purchase. We are trying to count for 500. We've already counted for 100. So we say the remaining 400 units that were sold on June 15th in the June 11th purchase at $12 each. 400 times 12, 4,800. Now we've accounted for the cost of the June 15th sale. We still need to account for the cost of the June 27th sale of 300 units. So should we go to this June 20th purchase? Not yet. Remember, from this 800 unit purchase on June 11th, we only accounted for the sale of 400. The company's constantly saying, let's assume we sold the earliest purchase. So we still have 400 units remaining from that June 11th purchase. We didn't sell all 400. We sold 300 units from the June 11th purchase. And that was at a cost per unit of $12 per unit, so $3,600. So the cost of goods sold under the FIFO perpetual method is 1,000 plus 4,800 plus 3,600, 11,400. And the nice thing to know about the FIFO method under FIFO, our cost of goods sold is the same, and ending cost of goods sold under, let me redo this. Cost of goods sold under FIFO perpetual equals cost of goods sold under FIFO periodic. So we don't need to constantly worry about each sale. We can just do this as if it's the end of the period, just like we did earlier in part A. And same thing, of course, ending inventory under FIFO perpetual. We can just use that much simpler method, ending inventory under the FIFO periodic. This is not the case for LIFO, but it is the case for FIFO. So we've calculated the cost of goods sold, but we have not yet answered the question in part C, which asks us to calculate the gross profit. So we need the sales revenue, and we do that in 3 steps. For the sales revenue here, we're going to come up and look at 200 units sold times $24 per unit. This was sales revenue of $4,800. 500 units sold at $25 per unit gave us revenue of $12,500. 300 units at $27 per unit gave us sales revenue of $8,100. When we add all that up, our total sales revenue was $25,400. So our sales revenue was $25,400 minus our cost of goods sold using the FIFO method was this $11,400, and so gross profit is $14,000. Part D of the problem says, why is it stated that LIFO usually produces lower gross profit than FIFO? So part D, LIFO assumes costs, well, before I get to that, let's say costs typically do what? Over time, go up, go down, or remain the same. Costs typically rise over time. LIFO says that most recent or more costly purchases are where? In ending inventory or in cost of goods sold? Last in or most recent is first out. Most recent costs are the ones sold. So the more costly purchases are in cost of goods sold. With LIFO, this resulting in higher cost of goods sold and therefore lower net income or gross profit. And that is the end of 8-10. In the next video, I'll work through 8-11.